We are diving deep into a really fascinating piece of analysis today. And, it forces us to look at a classic investment paradox. A stock takes a big dip, and the fundamental question is always the same. Is this a massive opportunity, or is it, the first sign of real trouble?
Right, the classic buy the dip versus falling knife scenario.
Exactly. We're focused on SIDU space. That's ticker SIDU. We've got an analysis report in front of us that is, let's just say, aggressively bullish. It's titled simply, "The Calm Before the Explosion."
No bearing the lead there.
Not at all. So our mission here isn't just to read the report, but to really stress test its main idea.
Yeah.
We want to find the core facts that support this very aggressive $10 price target.
And figure out if the volatility we're seeing is justified or if it's just noise that's hiding a major shift.
And the numbers creating this tension are pretty stark.
Yeah.
SIDU just closed at $4.01, sinking 6% in just one day. Yeah. But Wall Street analysts are holding firm on a price target that suggests a 150% upside from right here, right now.
That's a huge disconnect.
It's a truly massive disconnect. And for you, the listener, figuring out that gap is what this deep dive is all about. Okay, let's unpack this.
It's a critical gap, and you're right to focus on it. I mean, the entire thesis of this analysis report hinges on proving that this current dip, the calm, is just technical noise.
Technical noise related to share structure.
Exactly. Rather than a signal of, a fundamental weakness in the business, if they can't make that distinction stick, the whole $10 projection just kind of falls apart.
So we're basically looking at the analyst roadmap.
Yeah, for institutional belief. What makes them so sure that a defense narrative can beat out a dilution-fueled price drop?
Okay, so let's start right there with the calm. The stock's been on a fantastic run. It rallied from under $1 to a high of, $5.39?
An incredible run-up.
So then why the sudden 6% drop, landing us back at 401? What's the story there?
So the analysis identifies this drop as part of a, quote, healthy consolidation after that huge momentum. But the specific reason they point to is very clear. Dilution fear.
What?
This fear came from that public offering the company did back in late December of 2025, where they raised more cash. And, whenever a company increases its share count,
The price almost always reacts negatively in the short term.
always. It doesn't matter what the reason is. The market just reacts.
I get the market reaction, but this is where we need to push back a little. Wait, isn't raising cash through dilution usually a sign that a company's in trouble?
That's the default assumption, yes.
Like they can't cover their burn rate or their revenue isn't coming in as fast as they hoped. How does this report get around that risk, especially with the low revenue figures we're going to get to?
And that is the essential critical question. The report tackles it head on. It completely reframes the dilution risk.
How so?
The analysis actually calls the money they raised a war chest. The argument is that this money wasn't raised out of desperation at all. It was strategic. It was secured specifically to fund massive growth and to make sure they can execute on all these new high-value contracts they just landed.
So they're saying the company is basically seizing a moment, a growth window.
Exactly. And they needed the funding to scale immediately instead of, waiting for revenue to slowly trickle in.
So the dip we're seeing it's the cost of buying future growth. The analysis is telling us to ignore the technical headline.
And focus on the fundamental necessity. That's it.
Right.
The dip, according to this report, is just a market reaction to a balance sheet move that actually makes the company fundamentally stronger in the long run.
That distinction, technical volatility versus foundational strength. It feels like the whole pivot point.
It is. It sets the entire stage for the massive catalyst they expect will drive the stock, not just back to its high, but all the way up toward that $10 target.
Which brings us right to the core of the analysis, section 2, the explosion. So, if we accept for a moment that the company is fundamentally stronger with this new cash, what are the catalysts?
Right, what's strong enough to drive a 150% gain?
Yeah, what gets us to $10?
The first catalyst is really about repositioning the company. It's about changing how institutional investors think about it, getting them out of that risky small cap bucket.
Okay.
The analysis calls this catalyst number 1, the $151 billion defense play.
That number, $151 billion, is just immense. I have to contextualize that for the listener. How does a company with a, $261 million market cap even get mentioned with a number that big?
It's all about the total addressable market and the credibility they gain. So on December 22nd, SIDU was awarded a contract under the Missile Defense Agency's SHIELD program, the MDA.
Right, the SHIELD program.
And that program is part of a much larger umbrella of U.S. government defense initiatives valued at that $151 billion figure.
I see.
So the key insight from the report is that this one award instantly changes SIDU from just a general commercial space stock
Which trades on hype and speculation.
to a space defense player. And that's a whole different ballgame.
So they're moving from being like a general contractor to a critical infrastructure provider. It's like a small tech firm that suddenly lands a massive, long-term government data center contract.
Perfect analogy.
It changes everything about their risk profile. It guarantees potential long-term stable revenue and, serious government backing.
Precisely. Defense contracts are stickier. They're less affected by economic cycles, and crucially, they attract much higher valuation multiples because the revenue is so certain. The analysis argues this one contract fundamentally re-rates the entire company.
But, contracts are just potential. It's paper. Let's talk about execution. Proof. That brings us to the second catalyst, which moves from government contracts to actual hardware in orbit.
Yes. Catalyst 2. LizzieSat-3 is LVE.
Okay.
The announcement on December 10th was huge. They announced the successful commissioning of LizzieSat-3. And commissioning is the key word here.
Axis, launch, commissioning.
Right. Launching a satellite is one thing. Commissioning means the asset is now fully online, its systems are all checked out, and it is actively operational. It's ready for customers.
So it's not just promises anymore. It's a functioning machine up there in space.
Correct. And the analysis really stresses the consequence of this. This hardware is now generating recurring, high-margin data revenue.
High margin, that's the part that matters for profit.
It's absolutely key. It fundamentally changes the story. The company is no longer just surviving on cash from offerings or grants. They now have an asset in space that is actively monetizing its capability.
And providing real, tangible proof of concept to the market.
Exactly.
That's a great snapshot of what's happening right now. But a $10 target requires some aggressive scaling. That brings us to catalyst number 3. The 2026 roadmap.
Yep. So management's guidance has confirmed that LizzieSat-4 and LizzieSat-5 are already well into production.
Already in production.
And they're scheduled for launch later this year, meaning in 2026. So this isn't just a plan on a whiteboard. This is execution speed.
Right.
And if you connect this to the bigger picture, the analysis says each new satellite launch effectively multiplies their revenue potential almost instantly. The ground infrastructure is already there to handle the data.
So the roadmap shows that management is committed to scaling up capacity very, very quickly. But that rapid scaling also introduces a lot of execution risk, doesn't it?
100%.
Launching 2 complex satellites in quick succession is a huge logistical challenge. This is the uncertainty that the analysis seems to be minimizing.
That is the essential risk. The report is operating on the assumption of flawless execution. It's betting that the success they had with LizzieSat-3 translates perfectly to the next 2, with no delays, no cost overruns, no failures. A big bet.
And we can't just operate on hype and growth curves. We have to move to section 3 and ground all this optimism in, the concrete numbers, financials, chart analysis.
This is why we stress test the credibility.
Yeah, of that $10 target.
Agreed. So let's look at the financial tension here. The current market cap is about $261 million. The report immediately says this valuation is, quote, still tiny compared to the opportunity.
But the opportunity has to be weighed against what they're doing now. And here is the massive gap the report is trying to bridge. Trailing 12-month revenue, TTM revenue, is only $3.6 million.
Tiny.
So tiny. If you put a $10 share price on this, the market cap explodes to well over $600 million. I mean, that implies a price-to-sales multiple that is just astronomical, even for a growth stock.
It's a huge number.
You can't ask investors to accept a $600 million valuation today based on $3.6 million in historical revenue. What does the analysis say about the timeline? How fast does the revenue have to skyrocket to justify even today's price, let alone $10?
And that's a core challenge, right? The analysis is based entirely on forward multiples. They're arguing that the current low TTM revenue is irrelevant.
Irrelevant.
Because revenue is expected to skyrocket in 2026. They believe the combination of the SHIELD contract payments starting and the data streams from LizzieSat-3, MEDIF-4, and MEDIF-5 all coming online. It's going to cause a rapid, nonlinear jump in revenue over the next 12 to 18 months.
So they're not valuing it on today's numbers,
Right.
but on what they expect in, say, 2027.
Exactly. The analysis justifies the $10 target on anticipated 2027 revenue, and they claim the market will start pricing in that 2027 growth now.
Why now?
Because the catalyst, the defense status, and the operational hardware are already in place. They're not hypothetical anymore.
And that cash position, the war chest we talked about, is what lets them get to 2027 without having to do another major dilution.
Right. The report reiterates that the cash position is stronger than ever after that December offering. It removes the immediate funding concerns and buys them the time they need to execute.
Okay, that makes sense. So let's turn to the chart, the technicals. Why is today's $4 close seen as a buying opportunity and not a collapse?
The report identifies a very specific line in the sand for the bulls. It's the $3.80 to $4 support zone,
A support zone.
a critical psychological and technical area. And the fact that the stock literally bounced off $3.81 today confirms that buyers are stepping in right at the bottom of that range. They're defending the price.
So for technical traders, that's a sign.
It's a big sign. It shows that the sellers, the ones worried about dilution, have kind of run out of steam, and the fundamental buyers are taking over.
Okay, so if that support level holds, what's the path forward? How does the analysis see it getting to $10?
The immediate path is all about resistance. The next major resistance level they identify is $5.40, the prior high.
Right.
If the stock can break through $5.40 and actually stay above it, the analysis says that clears the path, technically, toward that $10 analyst target. The chart suggests there are very few obstacles left after that.
And just as a final confirmation on the bullish side, what's the consensus rating on this stock, according to this report?
It's unanimous. And that's always interesting in a small cap. The analysis confirms a consensus rating of a strong buy with 0 sell ratings from all the firms that cover the company.
Wow. That's serious conviction, especially after a 6% drop in one day. So what does this all mean for you, the listener? Let's try to synthesize this. The report is basically arguing that the current drop to 401 is a gift. It's an opportunity created by technical noise, and it's based on 3 core arguments for that explosion. First,
Fresh government defense contracts, the SHIELD program.
second, they have working satellites in orbit LizzieSat-3 generating real revenue right now.
And third, they have a strong cash pile to fund all the big scaling efforts in 2026.
The report's verdict is crystal clear. The calm is just technical consolidation. But the listener also has to see the massive risk here. The entire thesis hangs on perfect, immediate execution and a really aggressive 2026 roadmap.
No room for error.
No room for error. No significant delays in satellite launches or, and this is critical, in government payment cycles.
And this raises a really important, provocative question for you as you think about this analysis. The thesis hinges entirely on execution and timing. We know they are now a space defense player, and we know LizzieSat-3 is working.
Right.
So the ultimate question this report forces us to ask is this. Is the market primarily discounting operational success? Meaning they doubt the next satellites will launch on time, or is the analyst just overestimating how fast the Pentagon pays its bills?
Interesting.
Which timeline operational success or the payment schedule is the riskier bet for you, the investor, hoping for a $10 price target? That, right there, is the metric that separates the bulls from the bears.